So are we in a bubble? That is pretty much every conversation that you hear about the markets these days. AI stocks, gold, big tech. Everyone's got a theory about a bubble that's about to burst. But there is one bubble that is already deflating here in Canada. After nearly 20 years of nonstop growth, Canadian housing prices have been falling for the past 3.5 years. There's been no rebound, no V-shaped recovery, just a slow grind downward. And so slow, in fact, that you may not have even noticed it. But the facts are that sales are low, buyers are being cautious, and sellers are cutting prices at this point. Since 2022, the average home prices are down about 20% from their peak, closer to 30% if you adjust for inflation. And that's something that I'm going to suggest we should all pay attention to if we want to actually learn from the repeating of what's happened in the past. If we look at national prices, we're roughly on par with the US housing crash that triggered the 2008 global financial crisis. We're also in line with Ontario's own real estate collapse back in the 1990s. You can see that on this chart on your screen here. Now, I am going to note that there is something quite different about this downturn. First off, there's no wave of foreclosures out there. There's no mass unemployment. It's higher than we'd like, but it's not like we saw back in the day. But when you look at the depth of this, the duration, it looks like it's pretty much just as severe. When we look at those past downturns, it turns out that it took 10 years for prices to return from their previous peaks. Ontario prices took even longer. And I don't see any reason right now that this recovery isn't going to take just as long. Think about this. From 2005 to the peak in 2022, the average Canadian home prices more than tripled. They topped out around that $820,000 mark. And that boom was fueled by a few things: a record low interest rates that we had for a long period of time, of course, the pandemic savings, a whole rush of millennials and immigrants entering the market. But the side effect of that is that the boom to housing became central to a lot of Canadians' personal finances. Even now, homes make up over 40% of household assets in Canada. Stocks, that number is just 26%. And since stock ownership skews towards the wealthier households, it means that the middle class is especially vulnerable to the situation we're seeing now with falling home values. I am going to share something else that I find equally as concerning here. According to a recent survey by the Healthcare of Ontario Pension Plan, 62% of Canadians view home ownership as a major part of their retirement planning. Half of unretired homeowners say that they plan to rely on selling their home to fund retirement. A third say it's their only retirement plan. The bigger picture here, Canadians have learned to treat housing not as shelter, the traditional thing, but more as an investment, and in a lot of cases, even a retirement fund. And when prices start to fall, which they inevitably will, we're going through that now, that mindset can become a bit of a liability. This all ties into the income problem. As we noted, home prices have tripled in less than 2 decades. Real wages, though, they have barely budged. And the result of this is a generation that is now overexposed to one asset, and an asset that is now in a long correction. So we got a situation here. Everyone worries about whether the stock market is in a bubble, but there are millions of Canadians already living through a real one. I'm thinking, though, the silver lining here might be a lesson in good old-fashioned diversification. It is a reminder that when financial health depends on one market staying high forever. So that could be stocks. It could be housing. That's more of a gamble than an actual plan. So hopefully this correction we're seeing now encourages a healthier view of housing as shelter first and an investment second. Now, I do want to talk about America's growing two-tier economy. And we see the economy there booming and breaking at the same time. When we listen to some corporate earnings calls over this past quarter, a lot of them are saying the same thing, that there is a two-tier economy. For example, McDonald's chief financial officer, Ian Borden, he was asked about the challenged industry traffic trends that he noted earlier. And he said, "We've got lower income consumers that remain under pressure. Their visits to QSR, so that's essentially fast food restaurants, were down double digit again in Q2. Meanwhile, the higher earners are spending a lot more freely. That's fueled by the stock market gains and home equity. Economists are calling what we're seeing now a K-shaped recovery. So the top part of that K keeps rising, the bottom part falls behind. According to the Federal Reserve, today, the top 10% of Americans, that upper line of the K, own about 67% of total wealth. Now, during the pandemic, that split widened. Stocks recovered quickly, of course. Service workers didn't. And we had the government stimulus that helped temporarily. But as inflation stayed high, as job growth slowed, that divide returned, and it's returning stronger than we've ever seen it before. Another example on a recent earnings call, Scott Boatwright, he's the CEO at Chipotle. He says that middle income earners diners are visiting less often. He says that household under $100,000 a year is pulling back. We're not losing the customer, they're just coming in less often. Now, at the same time here, the wealthier part of society, the wealthier customers, they are trading up and they're buying premium products. They're flying business class. More about that in just a second here. They're upgrading their cars. Delta Airlines says that the premium seat sales will soon surpass economy for the first time ever. Look at Ford and GM. They're reporting booming demand for their most expensive SUVs. The Federal Reserve Chair Jerome Powell, he even acknowledged that recently. He said that the customers at the lower end are struggling, while at the top, people are spending. Another Fed governor, Christopher Waller, he blamed part of this on tariffs. He says higher income shoppers are price insensitive. They tend to absorb the tariff-related price hike, while lower income consumers will just walk out the door at those higher prices. So that's an interesting trend that we're seeing there. Before I wrap up here, I do want to look at another troubling statistic. These are U.S. numbers, but credit delinquencies in the U.S. among people earning over $150,000 a year have doubled since 2023. Same time, new high-paying job creation has slowed to its lowest level in a decade. Now think about this. Before the pandemic, around 38% of all new jobs created paid above average earnings. Today, that's around 7%. So while the upper half of this K is propping up luxury brands, airlines, the lower half just keeps cutting back. To top that all off, the middle class is actually is shrinking in size. So the real danger here is that this split will become self-fulfilling, right? You got policy, growth, that's going to start catering more to those who are still spending. That makes sense from a business perspective, but everyone else struggles just to keep up. The evidence right now is clear that the US economy is diverging. And when half the country drives the spending, the other half risks being left behind. Now, on that encouraging note, I'm going to remind you to subscribe, like the video, and remember, if you are struggling, stay strong out there. It's tough, but you'll get through. Thanks so much for watching. We'll see you in the next video.